gold is now the reserve currency. America, they whine about this. These American economists whine about this mercantilism. Listen, there's two sides of the same coin. If you want the Chinese to stop being mercantile, price your currency appropriately. The dollar is so overvalued against gold relative to what we make useful in the real world. And that's the issue. And so when we say globalism's over, yeah, I agree with Michael on that. What's that mean? I don't know if 38,220 is the price, but I think gold is going to somewhere between 5,000 where it trades today and 38,220 to balance the Chinese trade.
Gold has effectively regained its status as the true reserve currency, exposing the futility of American complaints regarding Chinese mercantilism. These grievances represent two sides of the same coin. If the United States wants to end mercantilist practices, it must set its currency at an appropriate price. Currently, the dollar is significantly overvalued relative to the nation's tangible output, creating a structural imbalance that marks the end of the globalist era. To restore equilibrium and balance Chinese trade dominance, gold may need to reprice dramatically, moving from its current level of $5,000 to a theoretical target of $38,220. LukeGromen, a macroeconomic analyst and founder of FFTT, LLC, argues that this repricing is the only mathematical solution to the current trade paradox. He suggests that the disconnect between financial valuations and real-world utility is unsustainable. As the global economy fragments, the dollar must devalue against hard assets to reflect economic reality and neutralize the advantages of foreign manufacturing powers. Now, we present the clips from LukeGromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
China imported 975 tons on net of gold last year. And so if I'm China, and I suspect this is what they're saying to Trump and Bessent and what they said to Yellen before them, was listen, stop. We are importing 975 tons of gold. The issue is not us overproducing with the left hand. The issue is that you are overvaluing the dollar relative to gold with the right hand. We ran a 1.2. So think about this. The Chinese ran in 2024 a $990 billion surplus with the world. It was the biggest surplus in world history as a percent of global trade, global manufacturing output. Biggest ever, 990 billion. Okay. China needs to strengthen it. They're manipulating their currency, blah, 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 mercantilism, blah, 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 blah. The yuan strengthens sharply against the dollar. Biggest move against the dollar in a long time. First half of 2025 was the worst drop in the dollar in 55 years. And yet in 2025, guess what China's trade surplus with the world was? 1.2 trillion, up nearly 25%, despite a much stronger currency. Okay, what's the real issue? The real issue is the dollar's wildly overvalued against gold. And I highlighted this in 2024, I highlighted again in 2025. If you take the $1.2 trillion trade surplus of China and divide it by the 975 net tons of gold they imported, it values that gold to balance their trade at $38,220. At $38,220, China runs a flat balance of trade. What's the implication? The dollar gets waylaid.
Right.
The gold is now the reserve currency. America, they whine about this. These American economists whine about this mercantilism. Listen, there's two sides of the same coin. If you want the Chinese to stop being mercantile, price your currency appropriately. The dollar is so overvalued against gold relative to what we make useful in the real world. And that's the issue. And so when we say globalism's over, yeah, I agree with Michael on that. What's that mean? I don't know if 38,220 is the price, but I think gold is going to somewhere between 5,000 where it trades today and 38,220 to balance the Chinese trade. That's until the dollar gets weak enough that people, say, hey, I can actually make more of a living as an engineer making something instead of like trading monkey JPEGs back and forth, or I can, day trade my stock account and make more than an engineer can. You get the dollar weak enough that we can make stuff here. And that's how you do all of those things. Is you settle in gold and you just let U.S.'s trade deficits bid gold to the moon until the dollar is appropriately valued, which is probably, I don't know, by the end of the cycle, I think DXY trades in the 60s, maybe lower. That's where this has to go. I think it's going to happen. I think it has to happen over the next 5 to 10 years. And you say, well, gosh, is that fast enough? Here's the reality. I put up a chart yesterday. It showed if you look at the S&P total return, right? So this is the S&P with dividends reinvested. Gold has outperformed S&P total return over 1 year, 2 year, 5 year, 10 year, 20 year, and 25-year basis. Basically, my entire career, I'd have made more money sitting in gold than in owning the S&P 500 total return. The only time it worked was in 2011. If you bought it 15 years ago, S&P total returns killed gold since then. Other than that, sort of every major and that was before we really started this change. Like, I think we are in the very early innings of it is a matter of national security for the US to settle trade deficits, at least partially in gold, because we need the price of gold higher. We need the dollar weaker. We need defense industrial production back here. We don't want to be reliant on the Chinese to both finance our military and make our military. It's a bad idea. And so the only release valve is gold. And so I think ultimately, look, where's it going? I think it's probably going 15 to 25,000, probably over the next 10 years. When you look and say, okay, a triple over 10 years, that's not bad. A quadruple or a quintuple over 10 years, you take that all day long. Now, from here, I think it's going to be more volatile than it has been because I think we're getting into that part of the cycle. And look, if I'm wrong, then the Western sovereign debt is unsustainable. And oh, by the way, the only thing you're going to want to own in that case too is gold.
Is gold, yeah.
Well, it's because, yes, and it's because of the setup, the way they've allowed the system to evolve. It is a certainty. It is a certainty that the United States Treasury market will sell off in any sort of deflation after some modicum of bid to the long end. And we've seen that 5-6 times going back to 2019, which is like, risk off, 10-year Treasury yields go down a little, and then about a week to 2 weeks in, they stop going down and they start going up, even though stocks keep going down faster and faster. Yep. That is a certainty. That is like a balance of payments identity for 2 reasons. Number one, for what we talked about before, which is foreigners are long $26 trillion of dollar assets on a net basis. That includes $9.5 trillion of treasuries. When you are in a crisis, you sell what you can, not what you want to. What do you sell to get dollar liquidity? Because you've borrowed 90 trillion or whatever on the other side, you sell treasuries. That's the structural component. The tactical component of that is that in October, the Fed came out with a white paper, and this is something we've been writing about for years, but it's fascinating to see it come from the Fed. They noted that 37% of the issuance of the United States in notes and bonds, so basically everything other than T-bills, everything on the longer duration treasuries, 37% of issuance was bought by the foreign investors in the Cayman Islands.
Okay.
Those are U.S. hedge funds.
Yep.
That is the basis trade. That's levered enormously. And the way that trade works, we've seen repeatedly over the last 5-6 years, is these hedge funds, when volatility picks up anywhere, they get a tap on the shoulder at 2 p.m. saying degross. Here's what the VAR, the VAR value at risk model or whatever they're using, you need to degross. Okay, what do you start hitting the sell button on? You start hitting the sell button where you're levered 20, 50 to 1 on these basis trades. And so tactically, 10-year Treasury yields start going up because they're selling what they can. And then it just feeds on itself. And then that also feeds on risk off, et cetera. And so it is... we've been harping on that and people have been very skeptical. I don't think they're as skeptical anymore after it's happened 5 or 6 times in the last 6 years. But if you get risk off, the Treasury market is going to start, 10-year yields are going to start going up within 5 to 10, maybe 15 trading days at most. And once yields start going up as stocks go down, you can set your stopwatch. You can just go, okay, set the countdown. They're going to come in with something that is, whether it's Trump tacoing, whether it's dollar liquidity, whether it's swap lines, whether it's not QE, whether it's RMP, reserve management purchase, whatever BS name they come up with, whatever, the BTFP, the bank term funding, buy the effing paper, whatever they call it, they always come in. And that's why, is they cannot, because the treasuries are the underpinning of all the collateral of everything. So they can't allow that to happen.
The global economic landscape is shifting towards a necessary devaluation of the US dollar to restore American industrial competitiveness. By revaluing gold to balance massive trade surpluses, potentially reaching theoretical levels upwards of $38,000, the US can neutralize foreign mercantilism and rebuild its defense industrial base. Historical data support this transition, as gold has already outperformed the S&P 500 total return across nearly every major timeframe over the last quarter century. A critical vulnerability remains within the U.S. Treasury market, where leveraged basis trades by offshore hedge funds create systemic fragility. During periods of high volatility, these entities are forced to liquidate treasuries to degross, causing yields to spike paradoxically during crises. This structural dynamic requires central banks to repeatedly intervene by injecting liquidity to preserve the collateral that underpins the financial system. Let's get back to the interview.
People have understood why the price of gold has been managed and suppressed for years. And it was to direct flows into U.S. financial assets and in particular to treasuries. If gold got too big relative to the treasury market, then that's going to create a network effect for gold. It's not going to flow into treasuries. It's not going to flow into U.S. stocks. And that's ultimately going to result in a weaker dollar. It's going to result in weaker U.S. demand for U.S. treasuries. It's going to result in higher rates. Well, think about what this administration and the Biden administration before it, what do they want? They want to make more stuff here. They want a weaker dollar. They want all of they don't want the Chinese buying our stocks. Okay, well, if we don't want the Chinese buying our stocks, and the Chinese don't want to buy our treasuries, as we saw from the headline today, even where they're openly telling their banks to reduce exposure to treasuries. And the Chinese, by the way, said we were going to stop buying treasuries 13 years ago in 2013, and really have been winding them down ever since. The only thing left over to big enough is gold. And so I think it's a win-win where, okay, Chinese, surpluses against the U.S. on the margin for at least some goods go into gold. Price of gold goes up a lot. The Chinese have been telling their people to buy gold since 2002. So the balance sheets of China and their banks, which need some repairing, given what's happened in real estate there, is going to go up a lot. That works for them. They can control that asset. We're not going to steal it because it's in their country. That works for them. It's inflation protected. That works for them. And for the Americans, we need a weaker dollar. That works for us. We want to reshore. Got to have the weaker dollar before we do that. We want the Chinese out of our country. That does that in terms of their money buying our assets. That works for us there. And, the nice little kicker at the end of it is once a gold price gets high enough, there's a provision on the books. Treasury can revalue the gold. It's just money creation using gold and buy back most of the Treasury market, certainly the duration. So you can control long end rates. It's a win-win-win. I think gold is the unspoken pivot of any deal that might already be struck, at least in the framework between the U.S. and China. It has to be. It's the only asset big enough. And critically, for who cares what I think, watch the flows. It's happening. Watch the price. It's happening. We were trying to get gold out of the system. We were trying to get the world to buy our treasuries and get, recycle their surpluses into our financial assets and get our factories out in the process. That's what we were trying to do in 1980, and from a policy standpoint, and from a in 2011, we were trying to sort of maintain that system. It's a matter of national security for the United States for the price of gold to go up, not down. In 1980, it was a threat, starting to become a threat to national security if it kept going up. You can read as much when Volcker said gold is my enemy.
Yep.
2011, that was still, Wall Street still dominated policy circles in Washington. And so gold's going up and up and up and up. And hell, they didn't mind it 2008 to 2011 because it told them, it was giving off a message of inflation and et cetera. That helped them get out of that crisis. They needed to inflate for a while. But once it got to a certain level, they didn't like that as much in terms of the message. They need it higher now for multiple reasons. If they want to reshore, if America does not want China to make the majority of its weaponry for America within 5 years, then America needs the price of gold a multiple of where it trades today. 60% higher to a multiple, 160 to, 400, 500% higher. I don't know what the right number is. I can offer different perspectives on that. But it is so different now versus those periods of time. Now, people say, oh, it's never different this time. It is. You're right on that level. It isn't different this time. 1973 to 2020 was the only time in world history where the debt of an insolvent sovereign served as the primary reserve asset for global trade. That was the anomaly. We're just reversing that. And so it's really, I think, the biggest, in 2017, I called it the biggest mean reversion trade in history. a couple different presentations I did with gold at whatever, 1,100, 1,200, 1,300 bucks. So I think gold, I think it is different than the last 50 years, but it's no different than what it was the prior 5,000 years. And ultimately, when you look at the imbalances as they exist, the United States needs gold way higher than it trades today. The Americans have to export real goods. The Americans don't make anything real after 40, 50 years of that old system. If that system was over, you know what one of the number one symptoms would be? The Americans' number one export being non-monetary gold, because we got nothing else to send that anyone wants from a competitive standpoint. From a cost perspective, at least till the dollar, right? The Chinese make a nuclear power plant, 1 gigawatt to 1 gigawatt. Gigawatt's the same here or there. Chinese cost of that's 83% cheaper than America. So if globalism is over, the dollar needs to fall against the yuan by probably 60 to 80%. That's the meaning of the end of globalism. That's the meaning of the end of mercantilism. Gold would be the release valve for a lot of that. Well, you can look at it as when you look at U.S. foreign held debt, right? So if we go back in time, a chart I've shown a number of different times, the U.S. Market price of U.S. official gold, assuming it's all there. I do, but who knows? But let's assume it is for sake of discussion. The market price of gold of the United States 8,100 tons of official gold as a percentage of the foreign held portion of U.S. Treasury debt outstanding. Today, with the massive run that we've had, it's at 14 or 15%. So the market price of U.S. official gold as a percentage of all foreign held treasuries is 14, 15%. By way of comparison, when the Berlin Wall came down in 1989 and our unipolar moment in history started, it was 20%. So gold would have to rise by another 30 to 38% just to get to the 1989 price of gold relative to our foreign debt. And that assumes debt never rises. Our foreign debt never, ever rises again. Now, if we want to go back to the long-term average of that percentage, that was 40 to 60%, going back 60, 70, 80 years. So let's just use 50% in the middle of it. 50% from 15, you're gonna need what? 3 1/3, right? 3.3 times here, 17, 18, $20,000 gold just to get back to the long-term average. Now, if we had an honest to goodness dollar crisis, real lack of faith, and there's plenty of which we're all looking at that could trigger that, it's not my base case. But in 1980, the U.S. official gold against its foreign held debt was 130%. That's up almost 10x from here. Gold would have to go to $45,000, $50,000 an ounce to be the same gold price as gold in 1980 relative to our foreign debt. When you look at it that way, most people just have no concept of how much the debt has gone because it's such a big number. It's hard to fathom. So I look at that and go, yeah, it should do, gold to me, I think needs to be 10 to 20%, 25% everybody's portfolio. And the reality is most people own maybe two, maybe in America.
The historical strategy of suppressing gold prices to funnel capital into U.S. treasuries has transformed from an economic benefit into a national security vulnerability. For the United States to successfully reshore its industrial base and reduce reliance on foreign manufacturing, where production costs are 83% cheaper, a weaker dollar and a significantly higher gold price are now essential. Unlike previous eras in which rising gold was viewed as a threat to the currency, the current geopolitical reality demands that gold reprice higher to act as a release valve for global trade imbalances and to reduce the debt burden. Financial analysts emphasize the stark mathematical gap in current reserves. U.S. official gold currently covers only 14% to 15% of foreign-held treasury debt, a dramatic decline from the 130% coverage seen during the 1980 crisis. To return to that level of sovereign stability, gold would effectively need to revalue to $45,000 or $50,000 per ounce. This data suggests that a massive mean reversion is not just an investment thesis, but a geopolitical necessity to end the era of debt-based globalism. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.